Valuation and Risk Models. Valuation and Risk Models in FRM Part 1 focuses on the quantitative frameworks used to value financial instruments and measure risk exposures across financial institutions. The curriculum integrates statistical modeling, fixed income analysis, option pricing, and credit risk measurement into a unified approach for evaluating financial uncertainty. Candidates study value at risk, expected shortfall, stress testing, volatility estimation, and scenario analysis as essential tools for managing market and portfolio risk. The topic also examines valuation principles based on arbitrage relationships, discounting methods, and interest rate modeling. Risk managers learn how quantitative models support capital allocation, regulatory compliance, hedging, and portfolio management decisions. Emphasis is placed on understanding model assumptions, estimation limitations, and the practical challenges of applying quantitative techniques in real-world financial environments. This topic provides the analytical foundation required to evaluate complex financial products and monitor institutional risk exposures effectively. Value at risk and risk measurement frameworks. A major component of the curriculum centers on value at risk and expected shortfall as standardized measures of portfolio risk. Candidates learn how VAR estimates the maximum expected loss over a specified horizon and confidence level, while expected shortfall measures the average loss beyond the VAR threshold. The curriculum compares historical simulation, delta normal, and Monte Carlo approaches for calculating risk measures under different portfolio structures and market assumptions. Students analyze the strengths and weaknesses of each method, including issues related to non-normal return distributions, correlation breakdowns, and model sensitivity. The topic also introduces coherent risk measures and explains why expected shortfall satisfies coherence properties while VAR does not. Stress testing and worst-case scenario analysis are emphasized because extreme market events often exceed assumptions embedded in traditional statistical models. These frameworks help institutions quantify risk exposures and assess capital adequacy under adverse conditions. Volatility modeling and correlation analysis. The curriculum devotes substantial attention to volatility estimation and correlation modeling because financial markets exhibit time-varying risk dynamics and non-normal return behavior. Candidates study fat tails, volatility clustering, regime switching, and conditional versus unconditional distributions to understand why financial returns frequently deviate from standard assumptions. Techniques such as exponentially weighted moving averages and GARCH models are introduced to estimate changing volatility patterns over time. Students also learn how implied volatility extracted from option prices can provide market-based forecasts of future uncertainty. Correlation analysis examines relationships between assets and how dependencies change during periods of market stress. The curriculum highlights the importance of updating volatility and correlation estimates continuously because inaccurate assumptions can produce misleading portfolio risk measures. These concepts are fundamental for portfolio optimization, derivative pricing, stress testing, hedging strategies, and enterprise-wide market risk management frameworks. Credit risk models and capital measurement. Valuation and risk models also focuses extensively on credit risk measurement because credit exposures represent a major source of financial institution losses. Candidates study default probabilities, recovery rates, expected loss, unexpected loss, and hazard rate models used to evaluate borrower creditworthiness and portfolio credit risk. The curriculum compares external and internal credit ratings while analyzing rating transition matrices and the relationship between ratings, bond spreads, and default behavior. Advanced portfolio credit risk models such as credit metrics, Gaussian copulas, and the Vasicek framework are introduced to estimate economic capital requirements. Students examine how loan defaults become correlated during economic downturns, increasing systemic vulnerability and capital pressures. The distinction between economic capital and regulatory capital is emphasized because institutions must balance internal risk assessment with external supervisory requirements. These models support lending decisions, credit portfolio management, pricing, provisioning, and regulatory compliance activities within financial institutions. Fixed income and option valuation models. The curriculum develops sophisticated valuation techniques for fixed income securities, interest rate products, and options. Candidates study discount factors, spot rates, forward rates, yield curves, and arbitrage pricing relationships used to value bonds and fixed income portfolios. Duration, convexity, DV01, and key rate analysis are introduced as tools for measuring interest rate sensitivity and constructing hedging strategies. The curriculum also explores term structure modeling and non-parallel yield curve shifts affecting portfolio valuation. Option pricing models include binomial trees and the Black-Scholes-Merton framework, which are used to value European and American options under different assumptions. Students analyze implied volatility, delta hedging, and option Greeks such as gamma, vega, theta, and rho to measure sensitivity to market changes. These valuation methods provide essential tools for pricing derivatives, managing market risk, constructing hedges, and evaluating complex investment strategies. Applications and strategic importance in risk management. The overall purpose of valuation and risk models is to equip candidates with rigorous analytical tools used throughout the financial industry to evaluate uncertainty, allocate capital, and manage financial risk. The curriculum integrates market risk, credit risk, operational risk, and valuation methodologies into a comprehensive framework for institutional risk management. Candidates learn that quantitative models are powerful decision-making tools but also recognize the importance of model validation, scenario analysis, and professional judgment when interpreting results. The topic emphasizes that inaccurate assumptions, weak governance, or over-reliance on mathematical models can create substantial financial vulnerabilities during stressed market conditions.